It's a historic day. It is a historic day. We are watching this unfold before us. We've had it so good for 11 years with these markets. Let's bring in Andrew Challenger. He's Senior Vice President, and he's also at a career transitioning firm, Challenger Gray and Christmas. We've also got Chris Konstantinos of RiverFront Investment Group as well. Thank you both for joining us as we've now watched the markets here see its worst day since the 1987 market crash, Black Monday. That is the context of the history, this moment that we're in right now. Chris, I want to start with you. The Fed announcing this $1.5 trillion new infusement into the financial system. Markets liked it for a whole 20 minutes, and then we fell back down, and we ended the day down 10%. Why did they think that this was going to solve something with investor sentiment?
Well, I think the Fed felt like they had to do something to make sure that near-term liquidity needs were being met and that the financial system was operating properly. And so they did that. But I think that is definitely missing the larger picture here, which is this isn't just about the Fed. It's about all global central banks. I think the powerful thing that central banks could do right now, frankly, is to make a joint statement, not what we saw last week from the G7. That was vague and pretty weak. I mean, really come out with a shock and awe where you've got all the world's major central banks pledging something that no one expected. If there was ever a time to do helicopter money, this might be the time to think about something that drastic in order to bring some of that this extreme pessimistic sentiment out of the market.
Okay, and so considering where you would like to see more of this action going forward as well, what's the announcement that you look for from the administration at a time like this, especially given that we've already heard from the president last night, but he continues to trickle out more information when it comes to the bipartisanship that we hope to see around moving some of these bills forward, but that there's also going to be a challenge on Capitol Hill in getting some of what he mentioned last night through?
Yeah, well, we definitely know that what we got last night was not nearly enough, right? It confused folks. It scared some folks. Again, it was very vague. It didn't give us any new information. What we need to see is a very concerted fiscal stimulus that is broad-based. That doesn't just go to certain businesses, but affects all of the American economy in a positive way. Again, whether you're talking about policymakers, or you're talking about, from a political policymakers, you're talking about central bankers. There's a channel about expectations and sentiment, and they can drive that channel. If they surprise markets and do something that was unexpected, they can help turn around some of the sentiment just simply by saying things. This was true in the Janet Yellen era. This was true in the Greenspan era. This was true in the Bernanke era. But right now, we're not seeing that kind of concerted effort. And frankly, from the political side of things, I think there's a really legitimate concern that bipartisanship in an election year is getting in the way of helping Americans where they need to be helped the most.
Yeah, absolutely. And I do want to talk about, Andrew, on the other hand, what happens to the economy at this point? Because the markets, again, are one thing and certainly now reflective so much of what the economy could be going through. We've already had major analysts on Wall Street say that we are now in a global recession. Is that going to trigger something even broader when it comes to, we've had historical unemployment numbers here in the U.S., right? So how long will it take the markets to now penetrate into the actual day-to-day jobs market and our daily lives as well?
Yeah, 2 weeks ago, we were firmly in the tightest labor market we've seen in 50 years. So companies themselves are feeling a certain amount of whiplash. As far as labor is concerned, it tends to be a lagging indicator as compared to the stock market, where we're seeing right now some initial pressure on jobs. First, companies that have faced real supply shocks. So companies that have deep supply chains into China have been feeling the pressure of not getting parts and supplies for upwards of 2 months now. That's where we've seen some of the first rounds of layoffs. The next area that we're seeing immediately impacted is companies that are facing domestic demand shocks directly correlated to the coronavirus. So airlines, cruise ships, of course, hotels. That's where we started to see labor hiring freezes, and if it persists for much longer, we'll certainly expect to see layoffs pretty soon.
How far off are some of these major investment firms from putting money back to work at this point in time?
Yeah, right now there's so many unknown unknowns. I think most employers, most companies in general feel such a sense of uncertainty when this type of fear and paralysis takes hold. Companies just end up not making decisions at all, particularly around labor. We expect to see them hold on to people for a certain period of time until there's a little bit more clarity. I think some businesses are nervous about letting go really valuable workers. They let go all their IT workers today, and then 2 months from now we come out of this. It's very hard to hire them back. So in terms of labor, what we're seeing is just a lot of hiring freezes, not companies taking action on bringing people on board. Not a ton of layoffs at this point.
Chris, we know we've been telling everybody here, and we've been trying to get this message out. Don't panic, don't panic, don't panic. Are markets panicking? Is this what panic looks like?
I think, Hope, you said it earlier that this has a real historic feel to it. Yes. And all the near-term investor sentiment data that we track, crowd sentiment polls, put-call ratios, et cetera, we're now approaching truly historic levels of pessimism, which can be helpful in the near term. But let me bring up another point, too, that I'm always trying to think as a market analyst. I look at the current S&P 500 level and I say, what's being priced in here? In my mind, what's essentially being priced in right now is somewhere between a $15 to $20, $25 hit to earnings for 2020. And then you guess the multiple you want to apply to that, somewhere between a 16 and 18, maybe something given where we are with interest rates. What that basically means to me is that in order for the market to be priced where we are today, it's assigning about a 50% probability of a U.S. recession in 2020, which would, that would be your bear case scenario. And, at a market around 2,500 on the S&P, that's actually a very rational place. I think somewhere between 40 and 50% probability of U.S. recession, given the fact that we still have a lot of unknowns with COVID-19. That is a relatively rational place to find yourself. That's baking in oil at $30. That's baking in a 10-year treasury of 50 to 70 basis points. That's baking in very low inflation. So it's not necessarily that the market is acting irrationally. It's just acting on the best information it has, which frankly at this point is not very good. Now, another point I'd really like to make, though, is if you have an investment horizon that's anything longer than 5 or 6 years, meaning you don't need to get this principal back in the next 5 or 6 years. What you should be doing right now amid all this carnage is sharpening up your buy list, because today, right now, there's excellent U.S. companies, franchises, companies with competitive advantages that are being thrown out with the bathwater, so to speak. And those are the types of opportunities we're looking for. Even as we're de-risking our portfolio broadly, we're starting to build our buy list and of franchises we'd like to own for the long term. So don't let that escape your notice either.
Yeah. Chris, Andrew, hold on for a second here. We've got some breaking news as the New York City Mayor, Bill de Blasio, has just declared a state of emergency to fight the coronavirus outbreak. What's particularly notable about this, and paired with today's market move, is the market move was before this got announced, and you've still got other major states that have yet to declare a state of emergency. How might that affect and help some of the very people in submitting their claims, in getting ahead of how this is going to impact them and where they're able to ultimately find some relief, whether it's local businesses, whether it's individuals and hourly workers there, or whether it's some of the larger businesses as well that find themselves telling their employees to work from home more often. And this is just one case here in New York City. We're going to continue to watch, of course, where some of the other states and regions, we've already seen this in LA, for instance, some of the other states that have been rattled by micro outbreaks that have taken place there and have already had to declare those state of emergencies on a localized basis.
Yeah, exactly. Seattle, thinking about obviously Austin as well, and it essentially frees up these local municipalities into getting some more funds, emergency funds, and to do what they feel is necessary to try to contain something of this magnitude. Of course, we know that there is a region north of New York City right now that is under quarantine. There's National Guard there to try to facilitate getting food in and out of that area, and also to make sure those areas are clean. So far our systems, our transit systems are still running, our transportation systems with the subways and the buses. It remains to be seen if that will have any impact. And you think about a city like New York with, nearly 10 million people here in just the one, borough, or really all of them altogether. They need to get around. I mean, that's how we go to work. So
Yeah.
if that happens, I mean, in essence, we're shutting down the city as well. That has not happened yet. It's something that we have been trying to anticipate what that means. Paris, for example, and in France just today, just about an hour ago, the president of France, Emmanuel Macron, also talking about how this is one of the worst epidemics that they've seen in their country in a century, but that they will have public transport open as they're trying to deal with this. So I think it also really reflects the complexity. We are in a global environment, we are in a global economy, which is why you see when one country like China gets impacted, the rest of the economy is slowed down. But we're also a global economy from the perspective that we're all individual countries. And, in the US, it's much more complicated, let's say, in a South Korea or in a China, because you've got all of these smaller municipalities at the local governments, then you've got state, and then you've also got the federal as well. So we wanted to bring that news to you guys as it was breaking here in New York City. Obviously, we also heard that the Broadway shows are going to be canceled. We are joined this hour by Andrew Challenger. He's a senior vice president at a career transitioning firm at Challenger and Gray, here with us, as well as Chris Konstantinos over at RiverFront Group. So just want to reintroduce you guys as we go back to the markets, which again, seeing their worst day since 1987. Chris, we were, talking to you at the beginning of the interview here about the kind of historical moment that we're seeing right now. And I had talked about this yesterday with Brad here on Closing Bell and on Movers, that this seems like it might be the new norm, right? We had been 11 years of just gains after gains, and we had a new record high, right? Even as late as February for the Dow, which we are obviously off of at this point. Do you believe that we are going to be seeing numbers with these steep declines going forward from today, or do you think this is going to be it?
Well, if your question is, will we be in an era of heightened volatility for the foreseeable future, I think the answer is absolutely. And this is simply because of the uncertainty around the economic impact of COVID-19, plus the recent oil shock we got. If you're expecting every day to be like today, historically speaking, today is an extreme anomaly. So obviously not that volatile every day. What the market is essentially trying to suss out, and I think this is, going back to the earlier part of our interview, this is what we were having a robust conversation about, is what is the likelihood that the U.S. economy goes into recession in 2020? In my view, the market is currently pricing in about a 50% probability, which is also what a lot of economists are saying. If it turns out that we get through this as a nation in the next couple months, and that some of that pent-up demand from consumers and businesses reasserts itself in the second half of the year, I think that forecast will prove to be a little too pessimistic, and we'll look back at 2,500 on the S&P as a buying opportunity. If it turns out that indeed the U.S. economy does go into recession at some point in 2020, and that second half spike back up doesn't materialize, then fair value on the market is probably something closer to between 2,200 and 2,350. So again, I think that it's the market is very rationally trying to figure out what is the likelihood of recession. One point I'd like to make, though, on this is that the U.S. economy went into this health crisis in the best shape of any major economy by a long shot. Your other guest was just speaking about the robustness of the job market ahead of this, and the fact that layoffs aren't imminent. So I think that's one thing to consider. We've been advising folks to take their international holdings and bringing them increasingly back to the U.S. as they de-risk their portfolios, because we think when the U.S. emerges, we think it will emerge the strongest economy, just like it went into this crisis the strongest.
I love that you brought that up, and I'd said we were spoiled, right, the last 11 years. I mean, we to your point, in the healthiest position our markets kind of could have been to be able to withstand something like this. So I love that you brought that context up.
Just quickly, Andrew, we comment and talk about a lot of the executive changes that take place with you when we've had you on in the past as well. There are a lot of new CEOs in their positions right now at these companies. What action would you look for from them on an individualized basis when some of them are very fresh into the CEO positions so that they can show leadership to their current employees at a time where there is so much uncertainty around the health of their companies in some of these cases?
Yeah, it's an interesting point. There are a record number of new CEOs that have just entered their positions at the end of 2019, beginning of 2020, and they're going to be facing a test that many of their predecessors who came in after 2008 did not have to face. There are unique aspects to a health crisis that most CEOs in their lifetimes never have to face, and there's also not some clear leadership from government in multiple different aspects on what companies individually should be doing. You see a handful of companies that all other organizations look to. You see Silicon Valley companies. I've seen Walmart take some action. I've seen a handful. We've tracked about 26 companies that have made public announcements about what they're going to do to respond to the COVID-19 crisis. But each individual leader is going to face their own test, whether they follow the lead of some of their peers, or they hold back and they're more hesitant. Their tenure may very well be judged on how they make decisions during this period.
Absolutely. I want to thank Andrew Challenger. He's Senior Vice President at career transitioning firm Challenger, Gray and Christmas, and also Chris Konstantinos of RiverFront Investment Group. We really thank your time on this afternoon.